Hi, good morning everybody, and welcome to Oikonomika, Oikonomika, all about economics. And I'm very happy to be with you today, and please watch this video from start to end because I'm going to explain you everything you need to know about the UK yield curve, what's going on in the UK bond market, what are the volatility issues of the UK bond market, and what are the structural features or structural problems that underpin the all the volatility that's coming up in the bond market. And yes, so I would be very happy if you watch this video for as much as you can, because I'm gonna explain to anyone, also ordinary English people, forgive my English accent, which is not very nice, but I'll try, dear mates, I'm trying to explain you from a yield curve perspective, like the bond market, the yields, what's going on, why the 10-year was 4.84% on Friday, why the 30-year is now at 5.4%, so why all the interest rate, the cost of borrowing of the government, why it's going up so much. Okay, there are many things to say, so okay, first things first. The main issue for the UK economy, as everybody knows, is the cost of living. Okay, so everybody knows that the cost of living is very high. Rents are very high. Food, it's gone up. The cost of food it has increased, but maybe it's normalizing, and the cost of renting a house is very high. So all these factors, they all build into inflation. So the perception of the cost of living. So the perception of the cost of living as a measure for any statistical measure for the government, it's called inflation expectation. So what ordinary British people, English people, or Scottish people, what do they expect to be the level of prices of inflation in 3, 6, 12 months in future? Okay, so inflation expectation now are 3.3%, which is a reasonable level. I'm not saying that it's an okay level, because this should be 2%. Okay, the price stability parameter is 2%. So there is a perception, on average, of the ordinary people that inflation will be not 2%, but it's 3.3%, and this can vary or change. So it can go down or it can go up. As I say, it can be, inflation expectation can be 3.5%. So this is the first problem that the Bank of England and the ratios from the the Exchequer has. So we have inflation expectation, the cost of living crisis, that it's unanchored, it's unmoored, it's like a ship, it's a boat, not a boat, I mean, it's something that has left the mooring, and it's now adrift in the sea. Okay, and so inflation expectation are not anchored, they're not firm at 2%, because there are runaway prices that inflate in the economy, and there is a component of greedflation, like greedy corporates that push up prices. Because you see that services inflation was mentioned also by the Bank of England, great Bank of England. Services inflation is 5%. Okay, and the Bank of England has managed to cut rates to 4.75%. So actually, it's below services inflation. Okay, so they are taking a risk, and the market has answered in a different way. Yields are going up because the market, the cost of borrowing, is discounting what will be the average rate of inflation in the next years. It can be in next month, 6 months, 5 months. Okay, the cost of borrowing, it's the ability of servicing the debt, the inflation expectation, which are not a cost of living perception of the ordinary citizen. That is a data, but inflation expectation, I mean, what funds or large investment funds, they take actual data and then they they generate a curve like this one, and they see what actually is the probable, what is the probability of having a higher inflation in the next 10 years. Okay, for the yield on the I can tell you right now, for example, that the UK 10-year yield on Friday was 4.84. Okay, if somebody more nerdy and checking around stuff, and you go and check what is the premium that the government pays on GILTs yield that are indexed and linked to inflation, which is the other big problem that the exchequer, the country has, okay, in terms of finances, we see that inflation expectation for the next 10 years for the market are around 3.6 or 3.7%, which is actually a lot in line with this actual data. So the market is discounting higher cost of borrowing because the market sees that the UK economy in the next 2, 3, 5, 10 years, even 30 years, inflation will be structurally higher. Okay, so if I have a fund and I have to invest 10, 20 billion, okay, 5 billion, 100 million, whatever is the sum, on a 10-year, 30-year, 5-year gilt yield, and I know that inflation will be high for all the period my money is parked with the government, and I don't know how they spend it, because throwing away 20 billion on the IHS, okay, it's not very clever. You know, if I'm an investor, I'm a fund, okay, and I'm investing 10, 20 billion of gilts, and then I see somebody that throws 20 billion to health service, okay, people's lives are sacred, okay, life, it's a sacred thing, human life is a sacred thing, but 20 billion all in a row, what the hell are they going to do with 20 billion, just one department? It's too much, okay, so these are wrong choices that then exacerbate the volatility markets, because okay, I give you money, and then what you do? What is the choice? 20 billion on the health service, okay, it will produce something, but it won't enlarge GDP, it won't enlarge growth, so that I have a growth rate that it's functional to having inflation lower, so that the cost of borrowing can be can decrease, can normalize. Okay, so there are a lot of choices, and when you walk through a storm, oh my god, yeah, you know what I mean. When you decide to enlarge the government in the economy, okay, and then you shut down the private sector, that is a very bad sign for market, because bond market, those are private funds that are lending money to the government, and the government, what does, they say, okay, now we're gonna manage the economy, and we're gonna make the size of government larger than the private sector. Okay, so this is it's a nonsense. It's two opposite things that don't go together. Okay, they don't go together, because if I'm a private investor, even if I'm a British citizen, okay, I'm not me, but any English pal, any British person, they have money in their saving account. So that money, it's used out for propping up businesses, okay, for providing credit, yeah. Or if you are paying taxes, everybody's doing its own due, it's paying its own due to the government for the well-being of the country, of the population, which is a good thing. But then the government, how manages this money? So if the government becomes larger than businesses, then it's normal that businesses, it's normal. As a consequence, businesses are shutting down, and the output, the aggregate of all that is produced in the economy, it's less and less and less and less. So yeah, would you want to call it a socialist state? No, it's not really a socialist state, because the old China, they run the economy, and they have a model which is somehow successful, but they don't have politics. Okay, they have technicians that manage the different regions in China, and they have targets that they have to achieve. It's not just a politics talk show, which I don't like. I prefer to watch comedians, English comedians, that they are amazing. It made me laugh a lot. It's unbelievable. So these are the first hints. So we have that inflation expectations are above 2%, and they are. This is not under control. Still, is a runaway problem. Okay, I don't believe, I don't see, and also the bond market don't see that inflation will be converging to 2%. And this is a huge problem for the Bank of England. Okay, services inflation is 5%, rent inflation is 7.6%. This is a huge issue. Okay, so now I'm gonna be very rude, yeah, and I'm gonna be quite direct. And there is the real factor is that there is an asset bubble. There is an asset bubble in offices or houses and flats in Manhattan, which may cost you $10 million for having a shithole somewhere on the 10th floor, on the 20th floor in Manhattan. And the same is for the UK, because we know very well that the government, the past government, I don't want to blame the government, but the main driver of economic output for the UK economy for the past 10-15 years, a lot of economic activity has been construction, building sites, house buildings, commercial buildings, so all parts. This is something that the British people, I think they need to understand, and they have to reverse course, because now I'm gonna digress. In Europe, not in Europe, but in other countries like Italy or France or Spain, I think we are adopting a different philosophy. So we want to bring tradition into the future. We want to marry up together traditional things with technology and bring it to the future. Okay, so that we are anchored in our roots. We know who we are, we know where we stand, we know what are our root culture. Okay, Greeks, Romans. Okay, we don't mess around for whatever fancy exotic stuff, and no. And so this translates in how you live your city, your town. If you go in any major British town, you see that there are lots of developments like Liverpool, Manchester, Brighton, London, I don't know, wherever. They just demolish old buildings, which are the tradition, okay, and then they pull up these modern skyscrapers, which are an eyesore, are horrible. Okay, so I think this is the first problem, the first cultural, societal, and identity. Okay, why you are demolishing old buildings? I don't know how to grade to list. I don't know. I mean, historical building. I don't have now the exact definition. Grade listed 1, 2. They have a ranking for this stuff, and then you put up these modern buildings. No, just refurbish what is the original, the typical British architecture, right? And bring it into the future. That's what people want to see. That's what tourists want to see. They want to see what is the essential, core, vibrant character of an English person, of a British person. Okay, and English person, they are Anglo-Saxons. So the true British person, they are the Welsh, right? Because the British ethnicity, I don't like to say ethnicity because it's the British component are the indigenous population that were in Wales. Okay, so if I say British now, I would rather consider somebody from Wales, who is Welsh, from, I don't know, what is Swindon or Cardiff. Where is your address from? It's from Cardiff, right? Okay, so I'm digressing. I was supposed to explain you why English people, they are Anglian and Saxons, so they are from German tribes that went into Britain after the Romans. Okay, after the Romans, they've been like for 6 or 7 centuries. Okay, the history of modern Britain, it's perhaps a little bit more than 200 years. The history of modern Britain goes from 1800 up to 2024. So we are talking about 224 years. Okay, but civilization, okay, has been made for 1,600 years. First from the Romans, and then there were indigenous tribes in Scotland, which the Gaelic Scottish people, and then there were the British, which are the indigenous population of Wales, okay, Welsh, and then the Angler, the Anglian, and Saxon, which are from some region of Germany, that went into England, okay, and then this civilization, yeah, has made 1,600 years of Britain. Modern Britain is from the 1800, okay, or even from the first industrial revolution, the middle of 1700 up to now. So when you start to change all the buildings, of course you see all this modern stuff, all this Americanization, and then the house prices, the rent, they go through the roof. But English people, they don't see value for money, because houses, they cost a lot, but they are flats, and then you have some flats on the 20 floors, and then there is water pipes that are breaking, and all sorts of these services, and then they have to pay the maintenance service charge. So there are costs and costs and costs piling up. Rent inflation 7.6%, and house prices are higher. Core inflation 3.5%. The ordinary CPI inflation 2.6%. So inflation expectation 3.3%. RPI, retail price index 3.6%. So there is a problem of inflation expectation, and we have the yield curve, which is this blue line. Now this hunch here, it's basically it's an inverted yield curve. So it means that the market is expecting a recession within the next month to the next 3 years, next year and a half. Okay, but the borrowing cost, compare the purple line with the blue line here, it's inflated a lot. So why the borrowing cost is going up? So the borrowing cost is going up for another series of reasons that I can't explain you now. Sorry, I'm slowing down. I'm trying to take my damn code. Where it is? God damn it. Right, seeing my screen, I have nothing to hide, so I have no problems at all with that. So, as I was saying, I want to explain you everything. So we have the first concept is that inflation expectation, they are unanchored. So there is this Titanic, there is a drift, and since 2020 or since 2021, even before the 2022 energy shock and all the other problems, inflation has started to go higher, because people went out spending. It was very good time, very good time. People were happy of having liberty after all the disaster of the pandemic and everything else. But then prices have shot up, and everybody knows that. And now consumers, they are more aware, they are more choosy, they don't spend much. There are other statistics on the ONS that show how the amount of stuff that UK consumers are buying, it's less. Okay, so the amount of goods that people are able to buy, it's less, but prices are very high. So consumption seems okay, but if you go and scratch under the surface, you see that the amount of stuff that you can get, it's less. You go in a supermarket and you come out with a bill of 100 quid, mate, yeah, and you have just one shopping bag and a half, right? So you see that you spend maybe the same amount of money, but you get a lot less. So these also it's visible on the ONS data that the volume of sales, it's lower. It has gone down. So people, they are not able to afford to buy the same amount of stuff. And this also comes out in the growth figures, GDP. Okay, if I'm not able, if my money don't go far enough, apart from paying $1,000, $2,000 a month in rent, council tax, and all the stuff that people pay, if my money doesn't go far enough, yeah, then I'm not able to spend do consumption in the economy, or do some investments. I don't know, I buy a new car, I buy some machinery, I do some upgrades in my house, I buy some furnitures, you go in the economy and you use your money for investment or consumption. But if you have less and less money free to do that, then the consequence is that GDP is zero, or there is recession, right? Because then when there is less demand, then businesses, they start to produce less goods and services. So the output, the overall output of the economy in goods and services, it shrinks, it goes down, because there are no buyers for that stuff. And that is recession, right? It's plain and simple how it works. So inflation expectation, they are a huge problem. Inflation, cost of living crisis, okay? I don't like cost of living. Life, it's a sacred thing. It should never be twisted around with some talk show and stupid stuff. Okay, let's call it inflation expectations, which is the correct term to define something. So what I'm expecting, inflation expectations are not at 2%, and that is a problem. It's a problem for markets, because basically the exchequer, it has some large exposure on inflation-linked gilts. Okay, so what happens is that the government, to finance public spending, they didn't issue normal UK gilts, but they issued debt that is linked to the rate of inflation. So that's why I say there is an asset bubble. The higher and higher are these inflation values: rent 7.6%, services 5%, house prices, they continue inflating. Then the inflation uplift that the government has to pay on its debt, it becomes larger and larger and larger. So I hope unfortunately you have to see the problem now where it is. Okay, apart from energy prices, you have an inflating asset bubble that is impinging on the cost of servicing the debt. And this is not something that happens today, right? It's not something that happened like 2 months ago, 3 months ago, or whatever. This is has built up in decades. And for example, I'll show you what I can show you. I cannot show you anything. Okay, RPI response, 25th of November 2020. So the Treasury had a paper, you see, a response to reform RPI methodology. So they, in 2020, there is another, you know, when they do this committee, and so this discussion started in 2012, right? So in 2012 they had the first paper discussing about to basically change the inflation GILTs index, yeah, from RPI to CPI. Why? This is, and still it hasn't been done, right? So this is a problem that has been of mismanagement. You know, I had to be rude, and maybe I go above my my pay grade, okay, if any. But I had to do my research, and I say that I'm going to explain you everything because people need to know. Yeah, you don't have to believe on all the bullshit that you hear on this stupid 24/7 news cycle, okay? Because there are the facts are the data. So RPI is 3.6%, okay? Inflation is 2.6%. You have 1% more on RPI. So it means that the cost, the uplift, I will show you now. Hold on, buckle up, okay? Buckle up, right? The government pays an inflation uplift, okay? This is indexed to RPI, Retail Price Index, which is 3.6. And 25th, they started in 2012, and they put the paper into the forgotten rows and forget about it, right? Then they went back to this in 2020, and still hasn't been changed, and they know exactly what they are messing about with, okay? And now I will show you what they are messing about with. The amount of gilts issued in issue is 393.5 billion, right, mate? And the inflation uplift is 624. So this is the amount that the government raised into the market, and this is the amount the government has to pay for the inflation uplift. Now, what the fuck it takes to disentangle the RPI and change it to CPI? So you are saving a 1 percentage point in inflation uplift, okay? And say this is linked to 2.6% instead of 3.6%. And retail price index, it's always higher than normal CPI inflation, okay? So this is something that they can do tomorrow, and there is no problem. It costs zero and it saves you money, all right? Now, this one is the ratio, okay? So for this kind of index linked treasury gilt, right, that was issued 10 years ago, 12 years ago, the index ratio is, for example, 1.4, 1.5. What that mean? If the government raises 10 billion, right, let's say £100, okay, then the government has to pay back 100, let's use this one, £147, okay, which includes the coupon, the basic interest rate, which is this one, the basic rate, okay, plus the inflation uplift, okay? So 1.47, it means that 10-12 years ago there was a 47% premium to pay on 100 quid. Alright, now look at this, 2.86, 2.22. So the cost of borrowing £100, it's more than doubled. Why? Because of inflation, right? Oh, and now these are larger coupon. No, this is the same coupon. No, this is 4 and 1. Okay, it's a larger coupon, but the index ratio, it's much larger. Okay, so it means that for 100 quid, then the cost, including servicing the index linked treasury gilt, is £260 or £222. So it has more than doubled. And you see here, this has bloated in an amount which is unconscionable. No, the Bank of England, they cannot print 624 billion like tomorrow and say, okay, we pay off everything, yeah, forget about it. So this is the problem that is gonna, I'm sorry, the market is gonna push you around a lot around this stuff. They're gonna push you around, yeah, they're gonna take you for a ride, they're gonna push you around. So I have to warn. This is not a warning, but this is a reckoning. This is a taking stock of what are the issues that are basically the problems that are at the base of why yields are going higher and higher and higher. Okay, because you have this inflation linked issuance that it's causing problems in the market. Why? Because there are other technical factors which are that you see that. Let's do a quick math, yeah. All right, let's do it quickly. And so 624 minus 393.5, shite, 393.5, all right, 230.5 fucking billions, right? That they are inflation uplift, and they still haven't changed. I hope they've done it from RPI to CPI. Okay, so yeah, data, it's RPI is being published each month, and I had some simulation that by 2030 this index ratio, it could be 3.5. So for £100 the cost would be 350 quid. So I don't know, are they crack horses? I don't know. I don't know, are they nutters? Well, I don't know, what is the problem with these people? Why they don't do something that costs zero and say, okay, now we're gonna change it to CPI, and I don't give a damn. That's it, because it costs too much, and you have 230 billion in excess cost of servicing the debt, because inflation goes higher and higher and higher, and these are all long duration The maturity is 2050, 2048, 2068, 2030, yeah. So 2027, and already it costs you double, twice. The ratio is 2, so for £100 you have to pay 200. And this is all public debt servicing, which has been messed up. And this is not one person, this chancellor or the other chancellor or the other chancellor. No, bad enough everyone, you know, because this stuff has been going on for years and years and years. And the first time the UK issued this kind of debt security was in 1996, right? So this stuff has been going on for, well, 20 years, and it will expire, but the cost is, it's inflating, and this is a huge problem for public finances, right? And it's a huge problem for the yield curve, because you see this is the 10-year, and the 10-year is gonna be 5% in a matter of days. Next week, next couple of weeks, the 10-year will go to 5%. And I'll tell you another thing, because now I'm sorry I have to be rude, okay? But this stuff is going to 6%. I'm pretty sure. I'm pretty sure that the 30-year GILTs, if nothing is done, will go to 6%. The market will push you around a lot, because the government is spending too much, and there is no way they can spend that much that they want and then they can service 624, not at once, but all the debt that comes to maturity, they have a lot of exposure. And then there is another problem, that this stuff that is linked to inflation then requires hedge funds to hedge it. So the market utilizes something that is called inflation. What is the name? So basically is inflation. I can see here, I was reading about it, another paper. No, this is a very important paper. So yeah, inflation linked swap. So basically these are the derivative contracts, swap contracts, which are based on this stuff, the Sonia swap curve. Okay, we see also these are the Bank of England, but the Bank of England, the bank rate is 470, 475, but you see that 3 months or 6 months it's almost 5%. So there is probably this stuff indicates that there are issues in the market. Investors, they are skittish, they ask for higher yield. And the swap curve also, the 1-year swap curve is 4.3%. okay, so they are asking for a higher premium, because the 3 months Euribor swap curve is 2.3%. it's 2% less. There isn't this problem. The Euribor curve, the 1 month is 2.88, but the 12 month is 2.5. So the curve it's going down. The Bank of England curve, it's going up. So the Bank of England say, okay, we set interest rate 4.7, but the market says no. If I have to give you money for 3 months or 6 months, 4.7 is not enough. I want 4.8 or 4.9 or 5%. And if the yield, the interest rate, is higher, that is an indication of risk. So that investors, they perceive a lot of risk in the bond market, which is the gilt market. Okay, why? Because of this stuff, which it has been sorted out, and this stuff, I don't know. I don't know if they end up to the IMF to sort this stuff out. I'm not in position to foresee anything, but I have the data. Everybody has the data. All the people that do the work, they know what are the problems, and they give the merry-go-round around the talk shows and bullshit and stuff like that, and say the whatever. Okay, it's the dinghy, it's the alien pitching up from Mars. I don't know, it's a moist plinth or whatever. But these are the issues. There has been a mismanagement. Okay, so let's go and see what I've worked on, because now it's 40 minutes I've been ranting about this stuff and I should conclude the video, and but I want to show you the work that I've done, that I have for the yield curve, because volatility is going higher, so the market is moving. So these are the rolling standard deviation and the annualized standard deviation. Okay, and I did it for each duration from 1 month up to 30 years. Okay, so when these lines, you see there is a clustering of volatility. So volatility in the bond market, it's been higher for a consistent period in 2024, and this was 2022. Now it is very much possible that what happened in 2022 or in 2020 also fits through 2024. Okay, this is how mechanically volatility and financial market data work. The pricing, when you see pricing bid and ask, the price that you see today, it brings within it the muscle, the memory of what are the past prices, okay, and the past volatility. So past shocks, past volatility shock, they have a fit-through effect to today prices. Okay, so these are this line, they are the smoothed moving average. Okay, so the median rolling standard deviation, it goes from 2.5% every 7 days for up to 4.3% every 30 days. So in a month there are 21 days of actually market months, because the market works from Monday to Friday, right? 9 to 5, Monday to Friday. So the average 21 days vol, it's 3.7%, which is not little, yeah, because these are bonds, these are not like stocks or derivatives or things like that. And bear in mind that what happened in 2022 was a huge swaps problem, the inflation linked gilt market and the inflation swaps that funds used. I don't know, I mean, I have a broad idea on why the funds, they had to hedge their exposure, because if, for example, there are a swap, basically it's an agreement between two counterparties, between two parties, and one is paying the fixed rate of inflation and the other one is paying back the floating rate of inflation. So when basically I'm receiving a certain premium from this, a certain amount from this inflation swap contract, then what happens if I have to pay the floating rate and inflation goes up, then I have to pay a higher premium, and then I'll be losing money in this inflation swap. So funds, they had to use credit derivatives to balance their exposure to inflation-linked gilts, because of also the bond market volatility shock, because the Bank of England was raising rates and gilts, they went from 1.5% to 4%. So the fast change of the fast steepening of interest rate, the Bank of England did 25 hike. They had to do it, and the Bank of England now is not in a position of cutting rates. Yeah, the Bank of England is in a very difficult position because they don't help each other, and basically the whole structural government, they don't want to face to the fact that they have an underlying structural issue with inflation-linked gilts, and they have to resolve that stuff in order to calm the markets, because they're gonna push you around a lot and you're gonna be like a headless chicken, and yields, they're gonna go higher. Yeah, I'm pretty sure about it, right? I'm pretty sure. So they have to confront the issue, and it's not like making a statement and I'll cut here, cutting spending, but they need to confront the issue of the inflation-linked gilts, and that won't be easy. So the annualized standard deviation every 21 days, it's 59%. This is annualized, so it means that the normal parameter, it's multiplied by 252, which are the market days in a year, which are not 365. Monday to Friday in a calendar year is 200 and more or less is 252 days. So we see that we have a clustering of volatility. This is the 3 months. Let's see if I can make it larger so that you can read it a little bit. It's visible for you all. Volatility, clustering of volatility, all duration, the whole yield curve. There is volatility is going higher. And these are not, but the 3 months, 6 months, you see the line are trending down, so volatility it's higher, but it's not very, very high. The problem lies in the long duration. Okay, you see now the shape of the line, the smooth and moving average starts to change. This is 1 year, okay, but still you have a clustering. This is a long clustering. This is a huge clustering of volatility that comes from the 2022 spike in volatility. Okay, so past shocks, they are feeding through. They are feeding through now because the market, bond market, is not convinced at all. They've done their homeworks. They know what are the issues, and if don't see the issues resolved or confronted with, then you're gonna see clustering of volatility. And you see here the lines, they are turning up, and this is the 3-year bond. Yeah, the line is turning up and you have clustering of volatility. So the longer is the duration of the bond, and then you have consistent volatility. You know, you see the line is not here. Okay, this is a whole other ball game, guys. This is whole other thing. And this is not only the borrowing that happened in 2020, because you see, this is how the government has structured the issuance of debt. Because the average stock of debt is around 14 or 15 years. So it's long duration, and on top of that there is the inflation-linked gilt issue, which inflates the inflation uplift inflates with inflation, and the cost rises and rises and rises, and the index ratio for borrowing with that. So they should stop issuing that shit. Yeah, get it sorted out. I recognize I'm being very rude. I should moderate my dialogue here. So anyway, yeah, we have clustering of inflation, yeah? And the moving average, they are all turning up on the upside. So this is the 7-year bond, and these are the moving average, the rolling average, and this is the annualized moving average, and they are higher. The brown and red line, which are the 21 and 30 days annualized, they are well above 2%. They are at 2% volatility. They were higher. So now we see that normal inflation, normal volatility for longer debt duration, like 9 years, it's a bit higher. And now the characteristic is that there is clustering of inflation. So clustering of volatility for bond yields. Okay, so this is 9 year. Yeah. Now let's check the 10-year bond, sovereign debt bond, which is the 10-year yield. So these are the yield, not the price of the bond, but the yield, the interest rate. Okay, so normal measures are here. Okay, 2020 was pretty normal, more or less, because they had the emergency problem for QE. But thereafter, once inflation has gone out of control, then you have a huge spike, a huge peak in volatility, and yeah, now we see that these are higher. And so these are not good things for having a normal management of when you're issuing public debt and stuff like that, because it's you're gonna have a lot of volatility in the market, and I'm not sure this will calm down any moment. So let's say that the average rolling 7 days vol for the 10-year yield, it's 4.8%. Okay, these data start in 2012, and they are up to they are up to the first week of January. Okay, so it's 14 years of data. Okay, and I couldn't get more than that. So the 7 days rolling average volatility for the 10-year gilt is 4.8%. It's quite a substantial number. The 21 days, it's 8.1%. Okay, 8.16% to be precise. Which are here in this box. The numbers are very, very tiny. So, and so volatility is quite higher for being this like sovereign debt. And I don't know. I'll have to measure with other sovereign debt, but you see all the charts, they all indicate that there is higher volatility. Okay, now we see the 30-year gilt. Still we have a lot of clustering, and still we have peaks of volatility. We are having peaks now in the latest data, and the line, they are all shooting up. So the 30-year yield is gonna shot up. It's gonna increase in vol. It's gonna be higher volatility, and this is a double bottom, so this volatility is gonna be here. And I'm a little bit concerned about this stuff, because I'm sure that the 30-year could probably peak, even go as high as 6%. The 10-year yield would be 5% for sure, because the market closed at 4.84. So it's 16 basis points to make it 5%. But that's the risk that goes to 5.5%. Yeah. If you have a volatility event, like if the market push around the gilts market, yeah, and then they start to sell and they are forced to sell, and you have another episode as the pension funds and stuff like that, then it is gonna be very interesting, to say the least. Yeah, then I did some other statistical study of Poisson distribution, and yeah, I'm gonna skip on this because it's I'll have to. Yeah, these are interesting because this explains the standard deviation distribution. Okay, most of the distribution, the higher density, it's around the zero boundary, so not much volatility. All the line, the green, the yellow, and the red dashed line, they are the deviation, 1, 2, or 3 standard deviation from the zero, the mean, the average. And we see that all the charts, they point out that there are some large clustering, or somewhat of larger data that has been basically has built up when you have a 2 sigma or 3 sigma volatility move in the market. So when volatility is higher, and we have, like in the past weeks, yields are going higher, the bond market is jittery and it's moving around, then it means that the standard deviation, the vol, it's moving by 2 or 3 standard deviation. And you are basically recording data in this part of the histogram. Yeah, you are in these lines, the yellow and the red lines. Okay, and these are the yields. Okay, so we see the yields, and around 4%. Yeah, for all duration. This is the 2-year, 3-year, 4-year, 5-year, and more or less the most of the density of the yield that have been observed, like the data, most of the interest rate on the bonds have been between 0 and 2%. Okay, but you have some clustering of data where the yield is between 2 and 5%, or 4.5%. This is the 4-year. Okay, these charts are very valuable to understand the level of volatility, because this dashed line, it's 1 standard deviation, 2 standard deviation, 3 standard deviation volatility. And if you see the curve, yeah, let's do it on this chart. This is the 5-year gilt, 5-year yield. The curve, right, it has this line. This line is the middle of the curve, but the middle of the curve is not 0. So the distribution of the yield of the 5-year bond is not symmetric to 0. but it's symmetric to 1.82%. So the distribution is not symmetric, and you have this fat tail high yield value, high yield data in the past prices and also the recent prices. Yeah, let's go and check. 5 year 4.55%. That is the cost of borrowing for 5 year of the government, and this is here. Yeah, 5 year and 4.55%. It's here, and 4.55%. It's 2 standard deviation from the average yield that should be 1.8%. Okay, so these charts can give you a very strict, a very poignant, relevant measure of how the cost of borrowing has diverged from the average interest rate on a 5-year cost of borrowing, which should be 1.8 or 2%. Yeah, but today in the market, I mean past Friday, the cost of borrowing for 5 year was 4.55. Okay, so the average should be 1.8 or 2%. The market has priced 4.55%, and this is equals to 2 sigma, 2 standard deviation from what should be the average cost of borrowing. So the average cost of borrowing is 1.8% or 2% for 5 years, should be, but the market is pushing you around to 4.5%, and it's in statistical terms that comes out from the data. Then the data helps you to understand that the market has pushed you here in the 2 standard deviation boundaries in this curve, is pushing you in the tail, in the fat tail of the curve. Why this happens? This happens because the market, the investors, they know that there is risks in the sovereign debt exposure, and they push you away from here, from this line, which is the middle line of the curve. Okay, the Gaussian curve. Okay, you don't need to know whether it's a standard Gaussian or whatever, which is not standard because it's not symmetric to 0. So you already start from a different kind of distribution, okay, which is not normal. And this is the 5 year. So all the bonds, the 7 year, the 9 year, they are not symmetric to 0. The curve as a base, yeah, this is the 7 year, and we see that the average yield should be 1.8 or 2%. So the average yield is here. Okay, on chart there isn't the data. Let's say for argument's sake it's 1.8%, and then the market is pushing away here 2 standard deviation from what is the average rate of borrowing for the UK government. And let's see, the 7-year yield is 4.64, 5 year 0.55, 7-year cost of borrowing 4.64. So you are well here, you are in this tail here, 4.64. It's well above the 2 standard deviation. Okay, again, 9-year cost of borrowing, God's sake, I think I sweat a lot, I'm sorry. Okay, I don't have the 9-year here, I don't mind, but the concept I hope is clear. So you have here the most of the data, they are near the normal cost of borrowing, which is the peak of the curve, which is the average cost for 9 year, let's say 2%, but the market is pushing around this way to the 2 standard deviation or the 3 standard deviation, which is higher volatility, and higher volatility means higher cost of borrowing, and means also that investors, they are selling outright, they are dumping into the market GILTs, because they don't see that inflation expectation will be at 2% in the next 5 years, 7 years, 10 years. Okay, they've lost confidence in the fiscal position, and they've lost somewhat confidence in the ability of the Bank of England of doing something, because they can do something, they can stop quantitative tightening, they can stop selling into the market, but then all the outstanding stock debt, if the problem is not resolved, or the government says, okay, we're going to change fiscal policy and we are not going to issue any more inflation-linked GILTs, because we know that inflation is going to be higher for the next 5, 10 or 20 years. So there must be some very structural decision that it's able to convince investors that they're not going to lose money because inflation is going to be very high in the UK. And so when they have to buy UK debt, they need to ask higher yields, which is 2 standard deviation or 3 standard deviation from the medium yield. So the average yield for the past 12 years for the 10-year gilts, 10-year bond, 2%, okay, the middle line. But now they are pushing around here, and same concept is again, you see, you have clustering of data here between 1 and 2 standard deviation, and very likely not 3 standard deviation. That will mean 6% yield, okay. So the 10-year gilt 4.84, yeah, I should remember, yeah, 4.84. This is this is plus 2 sigma movement of volatility in the market. These are almost 3%. This is more than double what should be the average cost of borrowing, okay. So there are things that can be implemented to rescue the situation, but you need to, I mean, people who can take this decision, they need to be courageous, and they have to do something, okay? Which is not just throwing money and stuff. So unless the Bank of England decides to do quantitative easing, and they cannot put rate to zero. The Bank of England says, okay, we're gonna buy for the next 6 months, we are going to absorb the issuance of UK debt. They can do it, and that will calm the market, but then after 6 months they will be at it again. If the structural problems, the foundational problems, they are not confronted and resolved somehow, then I don't see the point of arguing about the, I don't know, how far is Mars and all those stupid things. And there is no point in having an opinion if you know what is the problem, you confront the problem, and you take steps to resolve it, because it is in the interest, it's in the well-being of the people, and it's in the interest of the government, the public finances. So I mean, I don't know. Okay, 30-year yield, medium cost of borrowing, let's say 2.2%, and they're pushing around. It's 2 standard deviation, it's gonna be 3 standard deviation because we are in the fat tail, and this will go to 6%, I'm pretty sure. But the average cost of borrowing, it should be 2.2 or 2.5%, okay. So see how far the market is pushing around the cost of borrowing, yeah, because there is no confidence, there is a loss of confidence, okay. So now, to study the volatility, then I had to do some GARCH models, the eGARCH and the GARCH model. So the eGARCH, it's able to capture the asymmetric volatility, but the conditional vol, it's high. Yeah, we are talking about 10 to 26%, and this is a forecast horizon in 12 months, and this is the 1 month yield. So this is short-term paper, and the conditional volatility, it's high. Yeah. So in the data per se, they carry forward a lot of volatility. Now it's important to understand that the data alone, only the yield data, it can be very precise, because you have to factor in to make a more complex model and interpolate the yield data with inflation, with I don't know, with deficit that happened in 2022 as a pass-through effect on 2024. And these are the distribution of the daily changes in basis points, okay. So we see that all the curves, they are more or less symmetric to zero, so more or less normally distributed, but they all have this long tail, long fat tail. In these are basis points changes. In 2022 you had 10, 15, 20 basis point change in one day. There would be a change of 0.20% in a yield, okay. Let's say that the 10-year goes from 3 to 3.2% just in one day, and these are basically, this is recorded in the data. Now this is the 3-month yield, okay. This was the case in 2022. In 2024
you have small changes. Instead of 10, 15 or 20 basis points, you are in the range between 4 and 8 basis points. But I think that, yeah. So, light blue charts, it's 2022. Red charts is 2024. We see that we have to consider this stuff, yeah? That there are fat tails from a side and another. And here already we are seeing 10 or 15 basis points. And yeah, 10, 20 basis points in 2022. Here we have less of a rate of change day by day. This is 2-year yield, very large rate of change, even nearly 40 basis points. So overall, in 2022, you had a large basis points daily volatility than 2024. But in 2024, still we have 5 to 10 basis points. It means that the yield goes up by 0.05% to 0.10% a day, yeah? So this is the interest rate. It goes up now in 2024. So things are not calm. The market are not calm at all, yeah? So let's go and see, yeah, because then when the duration of the yield goes up, this is the 10-year yield. In 2022, yet the volatility was very, very high, and then 10 basis points, almost even 30 basis points in one day. Now in 2024, the most you had 10 basis points. So 2022 you had higher volatility because the base rate from which the yield curve started to go higher was much lower. So the 10-year yield was, let's say, 1.5% to 2%, was around the average borrowing rate in 2022. What happens is that you had the 10-year went up to 3 and then went up to 4.5%. So you had a huge change, a huge increase in basis points, in yield. And this is, it's present, it's recorded in the data, because you had 0.2 or 0.3% yield increase, the cost of borrowing increasing in one day in 2022, because the base rate was very low and inflation was very higher, and all the market was pushing. The central banks around the world were hiking interest rate. So the rate of change, the speed, the velocity of change of the volatility shock in 2022 was much larger. But in 2024, the speed of change, thank God, it's 0.10% for now, and you never know, it can become very large volatility going forward if nothing is done, yeah. But now the yield on the of every yield or every gilt, it's higher than 2022. So the cost of borrowing in 2024, it's higher than 2022. Okay, so there are distinctions to be made. So the rate of change in 2022 was very, very fast and was very abrupt, and that created a lot of problems in funds because they had exposure to the inflation-linked gilts and they had exposure to credit derivative, interest rate derivatives, which are inflation-linked swaps. Okay, so rates were going up, inflation was going up, and the fiscal measures announced, they could all have created a lot of inflation, and so the market went haywire, and you had these huge, large volatility events every day, 10, 20, 30 basis points in 10-year gilts. But today is not different. Today, now in 2024, you have less daily volatility, but the cost of borrowing is higher. Why it's higher? Because you have a pass-through effect of what happened in 2022 into 2024. And here I have the charts that will show you the peak yield for both cases. But both 2022 is the foundation of 2024. So what happened in 2022, it's a factor, it's a variable that counts in 2024. Okay, so nobody is exempt from responsibilities, or because prices that you see today, they are they incorporate past prices. Okay, they incorporate past volatility. So it's silly to say, oh, is this person, is that person? No, it's the whole thing that fits through on itself, and then the market works on the data. It doesn't work on what I don't know, Joe the plumber says at some point what is the opinion of whoever. Yeah, no, the market doesn't work on what is my opinion. Yeah, I'm the last man on earth, right? But I'm trying to explain you that what happened in 2022, it fits to 2024. This is the third year yield, and the curve, it has a huge tail on the positive side, and you have 10, 15 or 20 basis points daily vol, so the interest rate goes up by 0.20% in one day. And now this is not symmetric to 0, it's symmetric to minus 2.5, which is good. Okay, so but it's not normally distributed in 2024, and you have days when the third year goes up by 10 basis points. Okay, yeah. I mean, this was Friday, but Thursday you have one day you had there was the yield curve went up by 10 basis points. There was a lot of volatility from Monday to Thursday. There was a lot of volatility, and then Friday a little bit less, but still the UK bond market was very volatile. Okay, now we confront the peak yields. The peak yield of the 10-year gilt was nearly 4% in 2022, and it started from 3.4 in October, September, and went down to 3 and went up to 4. Now, in October 2024, we start from 4 and we are at 4.8. Yeah, and now it's at 4.55 or somewhere around that value. No, it's 4.84. I'm wrong. 4.84. Okay, so we are starting from 4%, and the yield is up for the peak. For now, it's 4.84, but this is sure. You can bet everything you want, this will go to 5%. I'm sure. Okay, I'm very, very sure about that. So, peak yield for every duration. So, in 2022, the starting base for the 1 month yield, so the 1 month yield, it mirrors, it's exactly what the Bank of England does. So the Bank of England was hiking interest rate. In September it was 1.75, and then by the end of 2022 it was 3.5%. So this follows the Bank of England hiking interest rate. Now in 2024 you start from 5.1% in September, October 2024, and the Bank of England has begun to cut interest rate. So you see that the curve follows what is the real market curve for the 1 month yield. So this is the same 3 months. In 2022 you start from 2.4 and you go up to 3.6. But now in 2024 the 3 month it's 5%, so it's much higher than 2022 because it follows the Bank of England curve, and we are at 4.7 now. So the cost of borrowing is higher because it brings forward what are the past data. Yeah, this is normal. This is how it works. So the peak of the 6 months was 4.5%, and then it stabilized at 4%. In Q4 2024 we start from 4.9% peak, and we are at 4.7. So we are here, the average was 4%, now the average is 4.7. Let's see what is the market yield. 6 months 4.7, 3 months 4.7, 1 month 4.79, almost 4.8, which is the same of the 10-year. So the 10-year gilt yield is 4.84%. The 1 month it's 4.79, 4.8. Yeah. So for one month you have the same cost of borrowing for 10 years. This is not a good sign. It means that it doesn't matter if the government wants to borrow for 10 years or for 1 month. There is a lot of risk in the gilt market. Yeah. And this data, they give you all the explanations, which are facts. Yeah, these are facts. Okay, this is not anything that comes from the Andromeda galaxy. Right? So 1 year yield in 2022, the peak was 4.2.5%. Then now the peak in Q4 here it's 4.7. Has been 4.7%, but we are around the same values, 4.6%. So the cost of borrowing is higher. 2 year yield, the peak was 4% in 2022, and then it went down, yeah, to 3.4, 3.3%, because I don't know, maybe Quasitec was fired, probably, I don't know, I have no idea, but anyway, I'm joking, I'm just to have a laugh, but to see that now what happens that 2022 feeds through in 2024 and the cost of borrowing is higher because now it's 4.5% for 2 years. Yeah. And the 3 year was 3.8%, now the peak is 4.3%. So you're talking about a premium of half a percent. Yeah. 3.8 and now it's 4.3. So it's higher the cost of borrowing in 2024. And I don't know if in 2025 it's gonna decrease. I think there's the danger that volatility is gonna be higher and there's gonna be some market volatility, and I don't know then what they will do. 2022, the 4-year yield was 3.7. Now it's the peak in 2024 is 4.3, and we are around the same values. Yeah. Let's see no, we don't have the 4-year here because it's not the whole thing. Okay. I'm taking very long in explaining this stuff. So 5-year was 3.6. Now in 2024 it's 4.4, so it's higher. In 2022 the 7-year was 3.8, the peak was 3.8, and then it went down to 3.6%. Now we are at 4.4, even more. 9-year the peak was 3.8, now we are at 4.6%, so we see that it's higher and higher and higher. Yeah. This is the peak of 2024 and we are going higher. Ay, caramba. So 10-year yield, the peak was 3.8, let's call it 4%, yeah? Now the peak is 4.7%, and we are there, so the cost of borrowing is higher compared to 2022. The 15-year, it's higher, the peak it's now, and it's almost 5%. Yeah? 20-year, the peak in 2022 was 4.3%. Now it's more than 5%. Almost 5.2%. So there is almost whole 1 percentage point of borrowing cost, which is higher in 2024 compared with 2022. 30-year GILTs, the big issue, right? In 2022 was 4.3%, the peak, and then it went down to 4%. Now we are at the peak, and it's gonna go higher to 6%, at least to 5.5%. We are at 5.2%. So there is almost 1% more. 30-year 5.4%. So it's, if this is 5.4, in 2022 was 4.3, the cost of borrowing is plus 1.1%. Easy math, easy mathematics, yeah, easy algebra. So what happened in 2022 feeds through in 2024, and volatility is higher, and these people should be worried, not warriors, should be concerned of higher volatility in the coming months because the market is going down. So this is a seasonal correction in the stock market, and if they want to sell, they will sell. Yeah, they will dump stuff no matter what. And the more the stuff that they have it's risky, the more they want to get rid of this stuff, the risky stuff. They're gonna dump it. Yeah, and then it doesn't matter if you run in some fiscal problems because they are pushing you around to do something. Yeah, these are the distribution of yields. So the distribution are the prevalent data. So the distribution of light blue 2022 distribution, Q4 2022, Q4 2024. So the distribution in 2024 is between 4% to 4.7%. The distribution of yield back in 2022 was from 3 to 3.8%. Was much lower, the cost of borrowing. Okay, so there are differences, and these things, they are correlated one to another. Okay, we cannot ignore the fact that the volatility that happened in 2022, it's now feeding through in 2024. But why it's feeding through in 2024? Because the fiscal policy decision and all the other things that go around it, like hedge funds exposure, the composition of debt, the issuance of more inflation-linked debt, and then the hedges that funds have to take, it's continuing. And this feeds through 2024, and this is the 30-year benchmark, and yeah, we are at 5.25, 5.4%. The distribution, the prevalent market yield is between 4.6 and 5.25. The prevalent market yield for the 30 year in 2022 was 3.5 to 4.25, was much more moderate. So there is inbuilt risk, volatility risk, fat tail risk, higher interest rate risk, which are not under control. And it seems to me that no one has the farthest clue what's going on, right? And if then volatility goes up and whole hell breaks loose, then, you know, I will raise my hands up and say, I told you. And I've been repeating this thing. It's been about 2 years I've been repeating this stuff. And I've gone through the data more and more and more and more. So, projected path, okay. Hopefully, this other model that I implemented, calculating the probability of daily yield change distribution, it tells me that the yield curve, hopefully, the 1 month yield will go down, the 3 month yield probably will go up. I don't know why, like normal steepening. So these are what is the projected yield path, okay? What the machine has elaborated with the data, only with the yield data. And it goes, this is the 6 month yield, okay? You see, it will be between 4.75 and 4.5%. And this is, okay, the whole year horizon, the whole 2025. So 1 year borrowing costs could go down to 4%. Hopefully, I don't know, but we see that in the first 6 months of the year, the machine, just through the data, it shows me that it's going to be higher volatility. So there is volatility going down, up, and then it peaks. You have a rising borrowing cost. This is the 1 year. So this is basically the distribution of the data. Now let's focus on something more cheerful. Okay, so this model tells me that the yield, the borrowing cost, should be declining. I'm not so sure unless there is something in the market that happens. Now we see the 4-year yield, the gilt yield, is gonna breach through some critical values, yeah, and then maybe it will go down. So these are all machine-based simulation and projection of how the yield curve could behave. Okay, so in this model, in this case, we have a declining yield curve, which is good. I hope it will be this way. But if we focus on the 10-year, we see that we are around the critical values here, and then we will be 2025 will be around 4.8%. So the cost of borrowing will be, at least for the 10-year gilt, it won't be less than 4%. So still some uncertainty in markets, and that will depend on what will be the banking, what will be doing, and what will be inflation, if there will be growth, if there will be a recession, if there will be tariffs from the United States. So there are so many variables at play, and the machine simulation, it's only made with the it's worked through only the yield data. So all these macroeconomic factors, they're not accounted for. But anyway, this is the 15-year duration, 20-year duration, 30-year duration. Yeah, again, we see that the cost of borrowing will be in a range between 4.6 and 5.2%. This is what is projected to happen. And these are also other simulation. And what is the probability distribution that the 10-year gilt will be 5 or 5.5%? And this is not negligible, okay? Because this is not in a very large, improbable, small value, but the probability distribution, it's here, okay? So it's not a very remote, impossible thing, okay? So, and this is the distribution probability that the 30-year will go to 6%. This is a smaller probability, like around 20%, but the 10-year, it's between 20 and 40% probability. Well, this is frequency, sorry, but there is higher frequency, higher density of data, okay? Yeah, and this is basically the same model refined to see what can be theoretically the level of volatility in the next 12 months according to the GARCH and DGARCH model. And because this is the volatility of variance, we have to take the square root. So if we take the square root of 8 here for the 1 month, so we'll have 2.83 sigma standard deviation. Okay, the GARCH model is more subdued, it's more normal, yeah, not normal, but it doesn't have this upward steepening vol. Okay, the GARCH model tends to show you more asymmetry, capturing what are the extreme values on a distribution, just to, exactly to explain the extreme volatility. Okay, I hope you are following this video, and I know it's a very long video, and I've said a lot of things, so I apologize if I swear. I'm sorry, I'm really sorry. But anyway, so these are the volatility levels, and basically it incorporates higher vol, but I'm trying to convey the notion that something has to be done in order to calm the markets. But this can, square root of 16 is 4, of course I should know that. And then so these are all the vol, and for all, basically all duration, which is 4 year, 5 year, whole higher vol for the GARCH model, which is the red line. And the GARCH model volatility, it's high, it's a high value like 26 or 25 volatility variance, but it's pretty much flat, constant for the forecast horizon. Yeah, so this gives me a 12 months forecast horizon, and I can see in the data what the model tells me. Okay, the GARCH model tells me, okay, there will be a 26 variance volatility in the 10-year gilt yield, and I know that will be a 5 sigma vol. Yeah, 5 sigma, let's call it a 5% variance volatility. Okay, for the 9-year yield. So some volatility can be that the cost of borrowing will go higher, or the cost of borrowing will decrease, hopefully. But the GARCH, as I was saying, it tends to bring into the model, the output of the model, also extreme values. So it draws out in the chart higher vol. These are very high values. Okay, this is 20-year duration, 30-year duration, something like 36, 38 variance, 33 variance, which is huge. Yeah, it's huge. That's 33 like on a crucified. 5.75 sigma. This is huge. It's way above 3 standard deviation, and so that's why I'm concerned that there is a lot of built-up volatility in the market, in the yield curve, and this basically can generate higher volatility and very large sudden moves, sudden changes in the yield curve, and so you have a market shock, another volatility shock. And yes, then I repeat it again, the same probability distribution, and then it goes higher, where in this probability study the chart says 2 year, but I narrowed down the window to the next 180 days. Okay, so in the next 6 months, what is the probability distribution that the 10-year gilt yield will go to 5 or 5.5%? And this is very much probable in the next 180 days. Yeah, you see the red dashed line, it's 5 or 5.5%, so we are almost symmetric to full probability. Yeah, the same is for the 30-year going to 6%. So okay, this is 180 days, sorry. Yeah, so okay, the 2-year forecast horizon, I remember that it says this is very probable. So the longer is the forecast horizon, there is a high probability, according to the data, the 10-year yield goes to 5%, to 5.5%. Let's see the 180 days forecast, and the mean yield is this one, and these are the probability distribution. And let's see, yeah. So the probability distribution then in the next 180 days, the yield goes to 5%. It's here. Yeah, so it's very probable. It's highly probable. It's not a remote event. What is here? We see 95 upper bound. So there is a 5%, this is a VAR 95, so there is a 5% probability that the 10-year goes to 6% in the next 180 days. That's why these are volatility risk measures that to me are very concerning, and people, they should pick up the signal and really make sure or be prepared, because the market is going to be very volatile. So here we have a 5% probability that the 10-year gilt yield in the next 180 days, it will go to 6%, but it will go even to 7%. So you are talking about full-scale crisis. So that's what I'm warning. That is my warning, and I don't want this to materialize, because I'm not gonna gain anything from that. We all gonna lose, yeah, because this means that the bond market, the sovereign debt market, will be very volatile. So if we have a crisis in the UK, there will be a crisis in the United States, and there will be a crisis in Europe. So these are my warnings, and I worked through the data to see if anything can go high wire and wrong. So more than this I can't do, you know. And then let's try something more cheerful. So the mean yield, so the average yield on a 30-day basis. So this is the smoothed curve, and this will be the forecast, this red line. So the shaded area is very narrow, so the forecast is, it will be pretty much the same, around 4.7, 4.6%. Yeah, so this is the 3 months yield. The 6 months yield is slightly declining, yeah, but the average 30-day yield for all the other debt securities, it's showing higher lines. Okay, 1 year duration, 2 year duration, 3 year duration, the rolling average yield higher, 4 year, 5 year higher, 7 year higher, 9 year, my god, 10 year higher, 15 year, the 20 year, the average yield will be above 5%. The same for the 30 year, average yield is projected to be higher on a 30-day average rolling basis. Okay, so the machine does its work, and also doing another analysis and doing the ARIMA model, and you take the first difference, and then the machine does a reconstruction of the yield curve, and it gives you an outcome. And the reconstructed forecast, the basically short-term paper, 1 month, 3 months, 6 months cost of borrowing, it could be, it should be, and it has to be stable, yeah, but it will be high, yeah. When instead the forecast for all the other debt securities, ERA, is forecast to be slightly higher. The red line, it's a little bit higher. It's not very significant, it's not a very pretty and nice graph, but it tells me that the forecast doesn't do like this, okay? The forecast is high. So I have to take the data and see what the machine comes up with. So these are more humane, comprehensible volatility. So conditional vol, again, GARCH, eGARCH, GJR GARCH. So these are the clustering of volatility between 2022 and 2023, and this is 2024. So still we are having a persistency effect of volatility, which is due to the beta coefficient of the GARCH model. Conditional vol will be higher. Here we are talking about 0.8 to 0.1%. So this is more moderate conditional vol, but nevertheless, 3-month yield, clustering of volatility, higher horizon, it's 12 months horizon, so higher conditional volatility, which is not the standard deviation. This is not the same. Conditional volatility, it's a measure of volatility which is conditional to the expected value, okay? While instead the God's sake, this is the variance of volatility. So is volatility of volatility which is not conditional volatility, it's plain English, it's much better than my accent, right? You know. So this is volatility, variance of volatility, and it's much higher for the same GARCH and DGARCH model. Yeah. So I want to be precise in my explanation, and yes, going forward, the conditional volatility still gives you a here 0.01%. Yeah, very low conditional volatility, but nevertheless we still have clustering of vol. Yeah, it's decreasing vol, but still we have clustering, and what can happen is that this clustering goes up, and then you have a repetition, like repetita juvant, of these market vol episodes. Yeah, conditional vol for all the GARCH model applied to the different duration. This is the 3 year. You see that we have this curve. Yeah, so we have higher level of volatility clustering, which is not 0 baseline, but the baseline is 5%, which is here. This is conditional vol, this is not vol of vol. Yeah, so, and this will be the conditional vol going forward. 3 year, 4 year duration, we see the pattern, high baseline volatility, and the forecast horizon also high volatility. So these are all very consistent, but they 2020, yeah, for all these periods from 2012 up to 2021, let's say, between the 2021 and 2022, we have somewhat normal vol. Yeah, the baseline is here, but now the baseline is shifted here. The baseline was 2.5% for 10 years. Now, in the past 2 years, past couple of years, the baseline is 5%, conditional vol. So there is inbuilt volatility, which I'm repeating again, and I'm concerned, I'm concerned that there is inbuilt volatility, and this can go higher. Yeah. So all the charts tell me this thing. I mean, in the charts, it's clear from the line. Yeah, the baseline vol is 5% now, and these are other, again, Vaschek and CIR model, and this basically say that the yield curve probably maybe will go down a little bit. So blue line is Vaschek forecast, CIR model, 1 month yield going down, 3 month yield going down. The Vaschek model keeps it at same level for the next time steps 12 months. Yeah, so 2 year, the Vaschek model keeps the yield curve more or less at the same level as a forecast. The CIR model makes forecast the yield curve going down. Okay, so there is this discrepancy between the two models, and at the minute I don't have enough knowledge to understand why. I can only take stock of the data, of the outcome, and see what plays out in the market. But considering that there is higher volatility built into the market, both scenarios are possible. The Vaschek model is a more complete model because the Vaschek forecast, it accounts also for negative yields. So, well, anyway, the CIR model gives us more hope that maybe the cost of borrowing will go down in the next months, but the Vaschek model keeps it at same level. Yeah, 4.9, 4.5%, slightly decreasing, but still at very elevated level. And then, yeah, I tried to have some machine learning fitting curve, and these are approximations. I think this is maybe the most possible, I don't know, but these are machine learning stuff. And then there is the linear regression, and see, okay, the linear regression, it doesn't work very well. Okay, so let's take this regional lasso regression. So regional lasso regression, it's a refined model for the normal linear regression. Okay, so the regional lasso regression, it has this scatter plot, all these points, but the dashed line is the most, where the curve fits the most. So the dots should be, that are on the dashed line, should be taken as a point of reference for what should be the predicted yield. Yeah, and for example the 3-month yield, the most close to the line, it's 2.5% here, or less than 1%. So this model shows me that the average yield, which are closer to the perfect prediction line, which is this diagonal line, they are no way as high as is the cost of borrowing now. Okay, they are all near the 2.5% range. This is the 2 years, so we are getting closer to 3%, like the dots here. Yeah. Huh? So these values are what fit the most the perfect line prediction, and we are here 2% yield. So there is, this helps me to understand that the yield that we see now in markets, they are not what should be the average cost of borrowing according to ridge and Lasso regression, okay, which basically draws out a perfect diagonal line where the dots should fit around this line, and what is closer to this basically are should be the most prevalent value, will fit the most the regression. But if we go back on a linear regression, yeah, we see that the linear regression, the average value is this one, and see how the market yield has diverged from the average linear regression, and it doesn't fit at all. So these are basically two models that compare and contrast the data, and they make me understand what are the prevalent average value, and these are basically how many times have been observed or etc. So what fits the most are the values, that the dots that are closer to what should be the perfect prediction line. Then I want to go back up on these models, because these are based on the Bayesian probability posterior mean prediction. So basically what this basically draws out a channel, which is the CI confidence interval or credible interval with a 95% confidence, and the red line is posterior mean prediction. So basically this works with the prior data, and then it gives you a posterior nice nice posterior prediction. Naughty boy. Naughty boy. And so this Bayesian regression basically draws out also what are the level of the yield, and it fits the yield into the credible interval channel. Okay, and we see that we are at extreme levels. Okay, and so this should all basically converge hopefully to the median line somehow, but yeah, we see that the Bayesian prediction gives you these sort of charts, and now this is something that I haven't studied, but it's very complicated now. It's a long time chatting and blabbering, but we see that the yield went outside what is the normal range that the machine works out, and then we have some parameters, the alpha and the beta parameters, the distribution, and then the density of the distribution. It's all work between these values, the alpha, and yeah, we see here what is the density. It's in two shapes, the curve and the horizontal density of the alpha, beta, and sigma parameters. But anyway, this also is useful to see how the probability posterior mean prediction shows me what should be the interval, the credible interval, and how the market is picked outside these values, also as a sign of volatility. And we are in the upper range of posterior mean distribution for what are the Bayesian probability distribution of bond yield curve, the gilt yield curve. Okay, so these also are very interesting charts, very complicated, but we see that the longer the duration, 9 year or 10 year, we are going outside the the shaded area, the confidence interval, the credible interval. And this means also that basically there are outside yield values which are not in the predicted distribution. Okay, so again, volatility, yield values that are outside what is a Bayesian linear regression. So I apologize if I couldn't explain better this thing, but I'll have to study and I don't have the complete knowledge of. So having gone through all the nerdy stuff and all these things, I hope you enjoyed the video, and I hope that there won't be so much volatility, but yeah, we have this risk of in the next 180 days that the yield curve can see a lot of volatility, and that there is the risk that the 10-year going at 5% is in this probability density, which is very highly probable, and there is a 5% probability that the 10-year will go at 6%. So I don't know, let's see what happens in the market. Let's see if we have a big stock market correction, and this will basically imply a lot of volatility for the gilt yield curve. And with that, I hope you enjoyed the video. I hope I gave you a lot of explanation, and if you can, just type down a comment, thumbs up, just put a like if you can, and enjoy. All the best for all our English and British mates, and good luck.